Today we're going to talk about assumptions made during the pre-approval process and how they can ruin the home buying experience. A very important question to ask yourself once you are pre-approved is, does a $300,000 pre-approval always mean I qualify for a $300,000 home? The answer is no. What would cause this to happen? If a bank tells you, hey, you're pre-approved for this amount, why wouldn't you be pre-approved for the home that you love that costs that same amount? And here's why. It would be the common assumptions made when you're looking for a home and when getting qualified for a home. For one, are you looking at newer homes or are you looking at older homes? This might not seem like something you need to consider at the time you're getting pre-approved, but it really is. Because the variation in the property taxes and or homeowners insurance on these properties can cause a significant jump in the monthly payment, which is actually what you're being qualified for. Here's an example of home A, B, C, and D. All of these homes are $300,000. But if you notice, the payment on home A is $1,630, while the payment on home D is $2,330. That's a $700 variation on a $300,000 property. Here are three common assumptions that are made when an individual is being qualified for a mortgage. For one, that individual is looking for a newer home. That's not always the case. You'd also be looking for an older home, and it's important to consider that in the figures. Are you looking at bank-owned properties? In most cases, this isn't going to be a consideration. They're always going to assume best-case scenario, meaning you're buying a home directly from an individual who in most cases has a homestead exemption, reducing the property taxes on the property. And three, are you looking in communities with a homeowners association fee? When getting pre-approved for a home, an HOA fee is not typically something that's considered in a monthly payment, but definitely should be. Let's go through four examples of $300,000 properties and how the monthly payment can vary for each. House A is a $300,000 home and is your best case scenario, which is typically what's used when getting you pre-approved for a mortgage. It's got low taxes, low homeowners insurance, and gives you the lowest monthly payment, which works out well when trying to qualify you for the maximum amount and you already have a high debt to income ratio. But that's not always the case. House B is bank owned. Maybe you're out with your realtor looking for the best possible deal because everyone wants a good deal. And that might be a bank owned REO property or a foreclosure. But that's not always going to give you the lowest monthly payment. And the reason for that is a bank doesn't get to claim homestead on that property. And therefore the property taxes are typically going to be higher than that of an individual who's living in the home. That causes the variance between House A and House B of $250 per month. If you were qualified for $300,000 and that was already the top of your qualification level, a difference of $250 in monthly payment is roughly $50,000 in qualifying. So the home that you qualified for at $300,000 is now roughly $250,000. Which can make a world of difference when shopping for a property. Let's look at property C. Maybe you're not looking at a new home. Maybe you want to live further east in the case of South Florida, and in those cases you're going to see a lot of older homes. Well, these older homes are typically going to have low taxes, but they're going to have much higher insurance premiums. Maybe they have an older roof, or they don't have hurricane protection on the windows and doors. This again will cause a difference in the monthly payment from House A that you originally qualified with. House A at $1,630 versus House C for $1,830, all because of the difference in the age of the home. That's a tremendous difference. $200,000 is roughly $40,000 in qualifying price. So when you thought you were qualified for $300,000, you're now only qualified for $260,000. Now let's look at House D, our highest payment example. Did you forget to mention to your mortgage lender that you were looking at properties in HOA communities? That's an important piece to the puzzle because the HOA fee alone can cause a significant variance in your monthly payment. So House D would be our worst case scenario. It has high taxes, it has high insurance, and it has an HOA fee, causing the payment to be $2,330, roughly $700 more than House A that you were originally qualified with. What does this mean to you? It means that $300,000 home that you fell in love with is a house you don't qualify for, because now your qualifying level is only $150,000. Could you find a home that you love for $150,000 when you've already seen the home you love for $300,000? It's going to be difficult to do that. And this is why it's important to set your benchmark. Your benchmark is actually the monthly payment on the home. So in addition to the amount you qualify for, it's important to know what this payment actually is. The principal and interest portion will remain fixed, while the property taxes, homeowners insurance, and potential HOA fee can vary from home to home. Once you go out with your realtor and find the home that you really love, it's important to present this property to your lender so that it can run the numbers for you. If the numbers fall within your benchmark payment, you know you're good to go. Please take this information into consideration when getting pre-approved or pre-qualified for your new mortgage. Ask your questions below and I'll be sure to answer them personally.